Welcome to the second part of the video series about divergence. Previously we were discussing the basics, i.e. the types, what they mean and so on. Now we will go through more examples from the market and to show you how to interpret the signals, as well as first couple proper trading strategies. So it should be stressed that the divergence means that the price chart and the indicator are going in the opposite directions. Divergence can indicate a trend reversal or a trend continuation depending on its type. And so the main features of divergence is that it is a leading signal. Its confirmation can be obtained after the fact with the corresponding market movement. Generally, any indicator signal, a price action chart or wave pattern confirming the truth of a price movement or leading divergence signals can be considered a confirmation. So we have studied the theory. Now let's see practical trading divergence signals in different financial markets. Starting with a regular bearish divergence, which forms at an expected end of a trend. Traders often describe such situations as the trend is exhausting. So this chart displays a bearish divergence. It is marked with the blue lines. So you see that the trend should reverse soon, but we should have a confirming signal. So to define the entry point, we shall use the signal when the trend line, which is a dark green line, is broken. So when the reversal bar closes below the trend, we enter a short trade. I marked the entry point with blue. So we set a stop loss a little higher than the next local high, which is a red line. And so to fix the profit, we shall use a take profit that is twice as big as the stop loss, which is a green line, as you can guess. So the price goes down and we take the profit. Now we move on to regular bullish divergence, which is a perfect reversal signal. Just like with the bearish divergence, we should use the trend line breakout as an entry signal. And so this screenshot displays a perfect bullish divergence signal. The price is in the bear trend. Sometime later, there are two consecutive regular bearish divergences. I marked them with different colors and I will explain this phenomenon later. Now we should just take this fact into account. We just consider it like a strong reversal signal. So when you see a trend line to detail entry points, you should be able to draw it correctly. So the downward trend line starts from the first trend high to the last local highest high in our example. In the previous example with the bullish trend, the approach was the same, but the trend line was drawn across the lows. After the first bar closes above the trend line, we enter a long trade. And so I marked it with the blue horizontal line level on the chart. So like in the previous example, we set a stop loss a little lower than the last local low. The take profit is again twice as big as the stop loss. I should also note that taking a profit that is twice as long as the stop loss is not always the most efficient thing to do. In our case, we have to wait for a profitable trade for a whole month. So next you can exit the trade based on the combinations of the divergence signal with the other indicators and trading strategies. So I will deal with this in detail a little later. Now we will discuss extended bearish divergence. And so, unlike the previous two divergences types, this signal means the trend continuation. And so you can use extended bearish divergence to enter in the trend, following a failed reversal. So this chart displays a common case of extended divergence. There is extended bearish divergence where the indicator hits higher highs while the price are getting lower, marked with the blue lines. And so this signal should be followed by a false trend reversal. And so to determine the entry point, we use the moving averages MACD, namely they're breaking the zero level to the downside. And so usually when the MACD moving averages go into the positive zone, it is seen as a trend reversal signal. However, taking into account hidden bearish divergence, we expect a false breakout of this level. So when the indicator goes back into the negative zone, we enter a short trade. And a stop loss is set a little higher than the first high of the convergence formed, which is a red line. It is clear from the chart that the take profit, which is 2 times more than the stop loss, is hit by the price and exits our trade with the profit. Okay, so now obviously we will talk about extended bullish divergence right now. So this signal, of course, mirrors the previous one. It also suggests that the trend, this time uptrend, will continue. It is clear from the chart that the MACD histogram forms lower lows, while the price chart indicates the uptrend. And so I mark the extended bullish divergence with the blue lines. And so like in the previous case, we expect a false reversal of the trend. And the MACD moving average, do not confuse them with the signal line, goes below the 0 level for a moment and goes back. This is a buy signal. I marked it with the blue line on the currency pair price chart. So we set the stop loss like in the case with the previous trade. Only it is below the price low. The target double the distance of the stop loss, which as you see was reached quite soon. So now we will discuss false divergence signals. It is quite a common situation in trading divergence signals. The false signal of divergence is when the convergence or divergence of the lines doesn't result in the trend continuation or reversal as expected. And so you can reduce the risk of mistakes in 3 ways. First, of course, follow money management rules, then always set stop losses in each trade, and third point, filter signals using supplementary indicators or methods. And so let's explore the third point, of course, in more detail because it is more complex. So to filter out false signals, you can use supplementary technical tools, price action patterns, and for example, graphic chart patterns. And so let us study how to filter those signals using, for example, firstly, Bollinger Bands. So this chart shows an example of a false divergence between the price chart and the MACD histogram. And so following the divergence signal, the price starts moving down and even the MACD moving averages goes into the negative zone. However, the price falls to consolidate below Bollinger Bands, which means the price is likely to be consolidating rather than trending. And so the Bollinger Bands get close in the zone of the red circle, where the price goes into the opposite zone and it basically cancels the bearish reversal signal. Also, to filter false signals, you can use other trend indicators. Any additional signal delivered by trend indicators are stronger than the divergence signal. So, having learned the theory and the practical application of divergence, we can make up a step-by-step guide to trading divergence. So, let's start with how to avoid early entering when trading divergences. So, make sure you follow those steps. Number 1, define the trend direction currently ongoing in the price chart. Draw the trend line, other words. Then find out 2 consecutive highs or lows to spot the divergence. Next point, attach the MACD histogram to the price chart and define the highs or lows on the indicator corresponding to the price extremes on the chart. So, if you find out the divergence between the indicator and the asset price, define the signal direction. Next, determine the entry point, and to do that, you can check the bar that closes beyond the trend line to enter a trade. Next point is that the basic divergence strategy is suggesting setting a stop loss at a distance from the highest or the lowest low. And so the basic scenario also implies setting a take profit at a distance twice as that of the stop loss, as we discussed. And so this is a basic strategy, of course. It could be quite a good guide for newbies. And regardless of which trading method you use, you should always apply stop loss and take profit. You can't monitor your trading chart for 24 hours a day. At the right time, only these 2 tools will save your deposit and help you fix your profit. So if trade divergence signals, you set a stop loss above the highest high for a bearish trend and below the lowest low for a bullish trend. This chart displays an example of a reasonable stop loss marked with the red line, of course. It is a bearish divergence, so the stop loss is set a little higher than the local high. In the case of the inverse divergence, you set a stop loss beyond the local price extreme. This is within the divergence pattern. And so, trading divergence suggests following the trend, so you can exit the trade according to any reversal signal. I recommend beginner traders to set the take profit at a distance twice as long as that of the stop loss. This is a simple and often winning trading strategy. So, now let's talk about which indicators use to spot divergence. Traders most often use oscillators in trading, and the best divergence indicators are, for example, MACD, RSI, and stochastic. They are user-friendly and simple to provide quite accurate trading signals. And other popular divergence indicators are, for example, Chaikin oscillator, demarker, momentum oscillator, and volume oscillator. And you may think, but why these indicators? Well, each indicator mentioned a second ago is unique and has its own features and accuracy degree suitable for particular financial markets. I don't think you should limit yourself to the previously mentioned list, and the divergence principles will work with any technical indicators, to be honest, so you can use any other oscillator that suits you best. So, okay, in the previous examples, we have already used the MACD divergence indicator. And so, as we remember, MACD stands for moving averages, convergence, divergence. So, for the reminder, the MACD indicator is composed of 3 elements. So we should briefly discuss this. The MACD line, which is the primary line, that indicates difference between the slow exponential moving average, the EMA, and the fast EMA. It marks the trend direction. Then we have MACD signal line, which is the EMA of the MACD line. And we have the histogram, which defines the difference between the primary and the signal lines, which is basically the trend strength. And so, to find out divergence, you can use the histogram, as I described previously, or you can use the primary MACD line, which I will explain a bit later. So, diagonal lines in the chart highlight the MACD bullish divergence. Note that we shall define bullish and bearish divergence according to extreme points of the MACD line, which is the blue line in the chart, and not the signal line. And so, I marked the entry point with a blue level. And so, that was the MACD. Now we discuss the RSI indicator, which is of course the relative strength index, which identifies the overbought or oversold zones. Themselves as an entry and exit signals are quite good. But another trading signal is the RSI divergence indication. Like in the previous examples, there can be bearish and bullish divergences, and so blue lines mark the divergence between price highs and RSI highs. So there is a bearish divergence RSI, and we could see that the trade was entered when the RSI line goes outside the overbought zone, which is the blue horizontal line in the chart. And exit a trade when the RSI oversold signal is sent, marked with the points with the green circle. So next is stochastic hidden divergence indicator. So stochastic is of course another popular oscillator used in divergence trading. It is composed of 2 lines that often interact with each other. And like the RSI, a stochastic divergence indicator finds out the overbought and oversold state of the market. And the stochastic trading strategy with divergence suggests spotting convergence and divergences between the price bars and the main indicator line. So blue diagonal line marks a regular bearish divergence. And additionally, entry signal is delivered when the indicator line goes outside the overbought zone. And so the entry level is marked with the blue horizontal line. So we shall take the profit, which is the green line, when the indicator goes into the oversold zone and the meeting of percentage K and percentage D line. So this signal is marked with the green circle in the chart, and the hidden divergence stochastic oscillator is determined according to the same rule as in the cases with the MACD and RSI. And this chart shows an example of the bullish divergence. So you see that the same rules work as for the MACD. So the second low of the indicator is lower than the first one in an uptrend, and we could enter a trade when the confirming green bar closes immediately after the intersection of the stochastic and the second top. So I set a stop loss below the lowest low in the divergence, and the take profit according to the stochastic rules at the second retest of the overbought zone. So we can also exit the buy trade when the price breaks through the trend line, or just set a take profit at a distance, again twice as long as that of the stop loss. And so okay, that is the end of the second part of the video series. So we talked about signals, discussed couple strategies, and in the next one we will continue with the couple trading combinations that you could use next time you log into your trading account, one of which will utilize volume. So stay tuned for that. Till now, thanks for watching and goodbye.